Welcome to my channel. I'm the covered call guy, and my goal is to create $120,000 per year passive income using only covered called ETFs. Right now, my portfolio yields about $72,000 a year, about $6,000 a month, almost $1,400 a week, about $200 a day. Disclaimer before we start this video, this content is for information and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. So please always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you found online, and I could be completely wrong. Now, with that out the way, today's video is going to be for the new subscribers, for those who I see that my channel is growing, and I'm very grateful and blessed. Thank you all for subscribing, for liking, for commenting, for sharing the channel, for sharing my videos. This video is really for the new subscribers and for the new income investors, or for those who have been in the game long enough. But I'm assuming this video won't be as educational and as informative to you. So this one is really for the newbies. So this is my income hunter's guide. I'm going to be showing you how to transform the 10 largest index ETF into robust high yield income engines, and this is my breakdown. Hopefully this video would be extremely helpful and educational to those who are going to be new to the covered call or income game. Right, so look at these giants. Right, you've probably owned them or had owned them in the past. VOO, SPY, IVV, VTI, QQQ, VUG, VEA, IEFA, VTV, BND. If you don't own them or you've never owned them, you probably at least heard of them, right? If you are in investing world, you definitely have heard of VOO or SPY, right? You've heard the term VOO and chill. Right now, we're gonna cover call ETF and chill. I'm gonna explain how you can buy VOO but the income version, SPY but the income version, QQQ but the income version, VTI but the income version. Right? These 10 ETF control about $4 trillion. They are the default setting of investing, right? But are they doing enough for you? This channel is all about income investing. It's all about cover call ETFs, financials, financial independence, right? Fire. We're all about retiring early and or at least creating a second salary so you can use it before you're 60, 65 years old, right? We are trying to live our life. We are trying to find a way to break free as soon as possible, as fast as possible. Hopefully before 40, ideally before 35. And for those who are lucky enough, before 30. My mission today for you guys is I'm going to help you find the counterparts funds that stick to these indexes but use a smart active strategy to pay you at least 6 to 12% yields. So I'm going to be trying to find the counterparts to VOO, right? For those who are coming from growth and coming into the income field and you're worried, hey, I know the traditional route is a lot more safer and it's a lot more sustainable. But I can't live off this if I just buy VOO or SPY or QQQ, VA, VTI. I'm trying to find a counterpart. Well, welcome to this video because that's what exactly I'm gonna do for you. All right, why passive investing is broken right now. I'm gonna start off with always this topic. For those who are completely new to the channel, I always start off with this and give you an introduction, right? Your safe beta isn't safe. Here's the problem. Passive indexes are blind. Your SPY buys stocks, whether they are cheap or expensive. You deserve better than that. And let's be real, a 1.3% dividend yield from VTI isn't going to pay your bills. You need to sell shares to eat, and that kills your principal, right? You're saving 30, 40, 50 years at a 4% rate. Eventually, something's going to happen in the market, and you're going to need to eat more than 4%. The market might not rise 4 to 5, 6, 7, 8%. The income conundrum yields scarcity. You can't rely on 1.5% yields anymore, right? We've seen the risk in 2022. Your safe BND position crashed because of interest rate. That 40% hedge didn't work for you. Did it? It did not. That's fact. My solution, You need active counterparts that turn volatility into cash, right? One, stop buying Gen 1 trash. On this channel, Gen 1, Gen 2, Gen 3, those are terms I've made up. Those are not actual terms, but I like to break it down into Gen 1, Gen 2, Gen 3, just because it's easier to understand and see it that way, right? Gen 1 is the trap, you know, QYOD. They sell calls right at the money. Sure, you get a fat check, but you capped all your upside. When the market recovers, you get left behind. Do not do this. Then we have kind of Gen 2, right? Kind of like the daily resets. They're the upgrades, right? The I Spy, right? These are Gen 2, Gen 2.5. These are kind of like the in the middle, right? You can go both ways depending on your portfolio. These reset their cap every morning. If the market rips 10% in a month, you actually capture that overnight move. It stops the bleeding. Then we have Gen 3, right? I would say these are the more current, these are the more flexible, these are the more um, should be your core positions. We have SPY, we have Divo. We use, well, they use credit spreads to uncap the melt up moves, and we pick good stocks, avoiding the junk that drags you down, right? They're a lot more flexible, they're more tax efficient. They're able to change their strategy on the dime, and they're able to go with the flow with the market. My three strict rules for your portfolio. I didn't just pick random tickers, I put them through a gauntlet, right? If they fail, they aren't on this list. One, they have to protect your NAV. I prioritize strategies that don't eat your principal, right? Out of the money calls, spreads, and active management only. Two, they have to be robust. Static rule-based indexes get crushed. I want managers who adapt when volatility spikes. And three, sustainable pay. I want real yields from premiums, not your own money handed back to you as return of capital every single time. And of course, the bonus is total return. You shouldn't have to sacrifice all of your growth just to get a monthly check. All right, this is just the bonus of total return. But the three is a must. If it does not fit the three criteria here, I kicked it off my list. Your S&P replacement, right? So if you're looking, if you're a VOO or SPY guy, SPY girl, right? This is my game plan for you. You want to keep your beta close to 1.0, but turn that volatility into 6 to 12% yield. Here's how we do it. My top pick for you is SPY. This is your tax cheat code, the 1256 contract. We have JEPI as the defensive shield, and we have Divo if you love quality growth. So some of these tickers are SPY, JEPI, GPIX, and iSpy, right? SPY from Niels. Why you want it? A tax efficient spread. JEPI from JP Morgan, low volatility defense. GPIX, right? Dynamic override. These are the guys that are very flexible and can change on a dime with the market, so you can allow you to ride up with the market, and also creates a nice cushion when the market has a downturn. And I Spy, these are the daily resets, right? These are the ones that are going to be um, kind of pushing your um, portfolio along the way. Yes, if the market goes down, it does push it down also, but this is the risk you want to take. You know, these are the kind of like separation you want to have, is diversification essentially. The S&P 500, the deep dive. I hope I didn't make this small enough. So I do have a like a 34-inch monitor, and so when I'm making these PowerPoints, and I forget not everybody has the same monitor as me. If you're watching this on the phone, I'm sorry. Um, I tend to forget that not everybody has a monitor, or they don't watch it on their phone all the time. So if it is a little small, I apologize. I will try to uh, call out every single ticker letter by letter. That way you don't have to look at it on your phone if you're using the phone. All right, let's start off with Spy Eye from Neos, right? S&P 500 high income. This is the Gen 3 premier choice, right? It uses Section 1256 contract, giving you a 60-40 tax split. Plus, the spread captures the upside. You're getting the best of all worlds here. We have the Goldman Sachs Core Premium from GPIX. Smart dynamic writing. If volatility is low, they won't sell low. They wait for the right moment to write options. So think about it this way. You're driving a car, you have your foot on the gas when the traffic is free, right? You're gonna go and speed up. And then when the traffic is, you're starting to see traffic, You put your foot on the brake and you say, you know what? What's the point? I can brake here and just relax. Or you have cruise control, whatever it is, right? If you have a Tesla, then you activate FSD and you let it do its own thing. And then when you want to go faster, then you go ahead and manually drive, right? So that's the way Goldman Sachs funds, cover call ETFs kind of operate. Then we have Devo from Amplify CWP, Enhanced Dividend, right? They use a tactical active strategy. They pick 20 to 30 great stock and only overwrite when things get overheated. Best for preserving your NAV. Then we have the parametric equity premium, PAPI, PAPI. They use a systematic ladder. They focus on dividend sustainability and quality factors, giving you a higher floor. Then we have FYEE from Fidelity Yield Enhanced Equity. They are the quant alpha, right? Fidelity tries to beat the index with stock selection to pay for the cost of your hedge. Um, I love Fidelity. That's my brokerage, right? So I use Fidelity brokerage. I have two other brokerages, but they're more of like for fun type of kind of experimenting, which I don't really do often at all. If anything, it's like once in a blue moon. But Fidelity is my main brokerage. We have JP Morgan, right? From JEPI, JEPI. Uh, these are the giants, right? These are the titans. These are the ones with 40, 50, 60 billion dollars assets under management in these cover call ETFs. I think that they're the biggest in the game, right? So JEPI, it buys defensive stocks to lower your beta when then layers on ELN income, right? Giving you a 7 to 10% yield. Perfect if you have an IRA. But I'm not gonna get into it. This channel is not about 401ks, IRAs. We are a taxable brokerage, but this is what best for if you do have one of those accounts. Then we have I Spy from ProShares. These are the daily reset revolution, right? It resets the cap every single day. If we rally for a week, you capture almost all of it. So this is why diversification in terms of cover call ETFs is great. I got a comment why but there's why buy all of this if it does if it's just an overlap, right? So, to respond, if you didn't get my comment on that, it overlap is fine. What you're buying, you're not overlapping the strategies, right? So if you overlap in S&P 500 a little bit, that's okay. And the reason for that is, um, you're buying the cover calls strategy. So each cover call is unique. They don't operate on all the same strategy. Some do, right? That's why I'm picking certain cover call ETFs and saying, hey, you want this, this, and this, because each of them operate differently. One can be super aggressive, does extremely well only in bull markets. One does only well in choppy markets, and one does a fairly better job than all else in a downturn. So you're buying different strategies to kind of cushion and try to play the wave on every single. Um, you get to play the machine in every single machine at the arcade, so to speak. Right. All right. Back to the video. We have Global X cover call and growth XYLG. Right. This is the halfway house. They overwrite exactly 50%. So you are guaranteed to capture half of every bull run. Then we have SPY T, right, from Defiance S&P 500 income target, targeting 20% yield. They use daily credit spreads to aim high while protecting you from those extreme moves. Then we have First Trust Buy Right Income FTHI, right? These are the veterans. These are I believe one of the oldest. Um, Fundamental selections plus index overlay. Right, they use the managed distribution policy, means predictable income for you. So these are my top picks for S&P 500. They are the one that has passed my at least my 3 criteria and going into 4 as a bonus total return. As you remember, let me go back. Right, my 3 criteria was: 1, it has to protect your NAV, it has to be robust, and it has to be sustainable pay, and of course on top of that, a bonus total return. All right, then we have the tech growth, right? Don't cap your Nvidia. So if you're interested in the QQQ, these are my tickets for you, all right? But understand the danger zone. Tech moves fast. If you sell at if you sell an at the money call and Nvidia rips 20%, you miss out. That ruins your return. And here's your fix. This is my fix, my solution. Use spreads on the QQQ or daily resets. I'm sorry, QQI or daily resets on the IQQQ to keep that right tail open, right? So some of these are JEPQ from JP Morgan again, JEPQ. Why you want it? Best income and growth balance. Then we have QQI from NEOS, uncapped upside, right? It uses spreads. And then IQQQ, right? Pro shares, it ladder ups daily. And then we have FEPI from Rex Fang and Innovations, calls on the MAGS 7 only, right? So these are the top picks that has fit the criteria and has some historical data to support this. I guess I forgot to mention that I don't want any new funds that don't have some historical data to back it up. Yes, I know there are probably better cover call ETFs that have greater returns. However, safety is number one priority, right? Sustainable. So if it has shown me at least a year and a half, going on 2 years, maybe even some going on 3 years, that is some historical data that I can say, hey, look, it is sustainable. If those are under 1 year, I can't put this on this list because again, going back to my video, for those who are new, I've seen an explosion in subscribers. I want to make this video for the new subscribers that those are coming into my channel. These would be the picks for you if you're starting out, for the newbies, right? I don't want you to jump into the new next best thing. Those aren't always the greatest, right? The latest greatest isn't always the best. Then we have the NASDAQ 100, the deep dive, right? JEPQ, JEPQ from JP Morgan, right? If you have FOMO, buy this. It holds big tech names and harvest volatility for 9 to 12% yield. The best balance I've seen, right? The JEPI and JEPQs are the extremely solid. They're rocks. They're great. Remember, these are the titans, right? These are one of the 30, 40, 50, $60 billion assets under management. They're the titans for a reason. Then we have JPIQ from Goldman Sachs. They also use dynamic adjusting. They won't lock in low strikes right before earnings seasons. Volatility hits. Smart management. And the reason I have a lot more in here instead of here is because I wanted a full slide. These would be the actual full picks, right? And not just this. These are just some um, tickers that I'm using an example here. But these would be like the full pick I would suggest you pick from right here. Where am I? QQQX, right? From Nuveen Nasdaq Dynamic Override. This is a closed-end fund. The manager reduces override in bull markets. Plus, you can sometimes buy at a discount. Then we have QYLG from Global X Nasdaq Cover Call Growth. This is the Goldilocks zone, right? Just because it has 50% covered, you're guaranteed to capture half of those 40% tech rallies. Then we have Fidelity again, right? FBCG, Fidelity Blue Chip Growth. It uses an active beta, not an income fund, but the managers rotate sectors to preserve your NAV better than QQ can. So this one is a more growth. It does kind of try to play both sides of the game. I have it in here just because, again, this video is for the newbies. And if you're testing your waters, I want you to understand. I don't want your portfolio to be swinging so much, especially if you're new. Your emotions are gonna get dragged with it. Then of course I have to mention NEOS, right? QQI, right? NEOS Nasdaq 100 high income. Tech rallies hard. You need call spreads here. This keeps your upside open and gives you that 60-40 tax break. Then we have IQQQ, Pro Shares, tech rallies and clusters. This ladder up every day, capturing that specific open-end volatility premium for you. Then we have FEPI again, FEPI from Rax Fang and Innovations. This is the MAG 7 plus innovators. It captures individual stock, not the index. You get extremely high yield at 20+% from single stock volatility. So this one, you don't want to exactly make it a core, right? You want to have this as a core satellite, or a satellite to try and kind of complement your lower yield positions. Then we have QDTE from Roundhill. You want paid weekly? This is the one. It pays on daily volatility reversion. The massive income cushion can offset price declines for you. And then we have QQQT from Defiance Nasdaq Income Target. It uses a daily spread, right? The long call leg protects you from those 3 sigma melt up moves we've seen in tech. Now we have the small cap trap, VTI and IWM. If you are a VTI guy, a girl, or IWM, these are my picks. These would be my choices. First, let's avoid the zombie companies. That is the small cap trap, right? Passive small cap indexes like IWM are full of unprofitable junk companies. They drag you down. These are zombie companies. And why do I say zombie companies? Because in 2019, during the start of COVID, what happened? The Fed essentially cut rates to zero. And what happened when rate is zero? Debt is essentially free. They're basically paying you to take a loan now, right? So what happens when a company's unprofitable? They just take it out to survive. And so you start seeing a lot of these companies start failing now because rates are back up, even though they're about to cut rates again. So some of these zombie companies might survive, and they seem like they're doing well, but they're not. The balance sheet is terrible. Um, they're just delaying their death, right? Your move here, you need active management here to screen for profitability and cash flow. Don't buy trash. And some of these tickers that I think would do great is AVUV, right? From Advantage US Small Cap Value. Why you want it? It screens out the junk. And then we have QDivo from Amplified CWP Growth and why you want it? Active growth plus income. Amplified is probably one of the best defensive for growth and income I've seen so far that plays both sides of the market. They have a very long track record with Devo that I mentioned earlier in my previous slides, and QDevo is just Devo but on steroids. Then we have CAF, right? CALF from Pacer. Why do you want it? Free cash flow. And then we have IWMI from Neos Russell 2000. Why do you want it? It monetizes small cap volatility. And let's get into the deep dive, right? I've always got more for you guys. I try to give you the best of the best. I try to give you as much as I can. Um, so, right. So total market, right? The deep dive. If you're trying to get into the total market, this is it. This is the picks. We have AVUV, as I mentioned, from Advantage. They use quantitative active. They rigorously screen out the junk, right? 40% of Russia 2000 is trash, in my opinion. Again, I put that in, you know, um, I forgot what's this called. Is it not parentheses? Comma? Not a comma. I forgot what's that called, but I put that in there because it's my opinion. I think 40% of the Russell 2000 is absolute garbage. All right, so this ETF it is a total return play. Then we have CALF from Pacer Small Cap Cash Cows. Cash is king for you. This picks the top 100 small caps by free cash flow yield. That cash flow buffers you against recession. Then we have the great Neos, right? I always got to mention Neos. They've been doing great. They've been excellent. They've been on a tear. IWMI. They use a call spread on small caps. Small caps have violent rallies. The spread protects your upside while you harvest the volatility. Then we have DSTL from distillate fundamental stability. I don't know if I'm saying that right, but DSTL. They have quality value. It screens for low leverage. So that means this protects your NAV when interest rates are high. And of course, I gotta mention the fidelity, right? They are also one of the titans in the game. FYEE. They do core holdings. Their quant models generate alpha to offset the cost of option hedge. And of course, I mentioned QDevo. This is probably going to be one of the highest or one of the best in the list, in my opinion. QDVO from Amplify CWP Growth and Income, right? So it applies the Devo method to growth stocks. It gets you income from non-dividend payers while without you having to sell shares. So this is more of a growth first, right? So the priority and the perspective they tell you is growth first before income. All right, then we have OVL, overlay shares large cap, a passive portfolio with a specialized options overlay. It aims to smooth out your NAV path. Then we have Java, JAVA from JP Morgan Active Value. All right, so in my opinion, these are the active best ideas that they kind of pick for you. Um, they rotate into value opportunities and avoid value traps better than any static index. Then we have SCHD. Yes, this is not a cover call ETF. This is a dividend growth player. However, again, this video is for the newbies. If you want some income, you want to have some sustainability and stability, you have some SCHD just to have some rock in your portfolio so then you can kind of know where you're going. SDHD has a 4.8% yield, so it's just around Devil. I have it in here just because again this is not a cover call ETF. I was gonna remove it and put Devil, but I already have the list here. I didn't want to repeat it. It is a total market player. Uh, Maybe it was a mistake putting it here, but again, this video is for the newbies, for those who are just getting into income. Um, SCHD makes the income list. Although it is not a cover call, if I was strictly using cover call, I would have removed this. But I'm just gonna have it here for the example. Again, this video is for the newer people. I don't want you to diverge off into the best new hype stock. I want you to be able to keep your money. That is the goal of my channel. I don't want you to lose money. Um, then it's from Schwab, right? U.S. dividend equity. Um, it is a quality benchmark, right? Stringent. Their method. The reason the expense ratio is so low because they have like a 3-person team. I think they literally have a manager that just looks at the stock and go, okay, it uses an algorithm from a computer. Um, and the computer makes the selections, right? So it's stringent, screens 10-year payment, acts as like a active management for you. Then we have AVUS for Advantage US Equity. This is your core replacement, broad market, but with a profitability tilt, a better beta that protects your NAV. So again, this is all of the picks for total market. If you're trying to play total market, I disclaimer, I own QDivo. I have about 200, I think $200,000 in QDivo. Um, I'm looking into Neos also. So um, right now I'm building out Maggie, so I have a lot of on my watch list. I used to be a big growth player in SCHD until I moved completely into pure cover call ETF income. So I made the list just because I guess I'm a little biased. Like when it comes to the new investors, I do not want you to lose money and I do not want you to chase the yield. We are here to make money. We are here to try to retire as early as possible and enjoy the beach life somewhere nice and warm. All right, global risk. Why you're losing abroad. All right, so if you're into VEA index, these some of the tickers here is my pick for you. Don't buy value traps, right? International markets have underperformed for a decade. Passive funds are heavy in low growth banks. The key here, active quality selection, right? currency hedging, right? Strong dollar protection, and no 100 buy right strategies. Some of them are IDVO from Amplified again, right? IDVO is international ETF. Why do you want it? They have active ADRs plus tactical calls. Then we have IHDG from Wisdom Tree, International Hedge, Quality plus Currency Hedge. We have LVHI from Franklin International Low Volatility and Hedge. Then we have IGRO from iShares International Dividend Growth. Right, they pick growers, not yielders. And then International Deep Dive, right? We have IDVO from Amplified, active ADR selection. Managers pick growth, right? Over value traps, best nav preservation for you. Then we have LVHI from Franklin International Low Volatility. The, this one plays the dual defense, low volatility screen plus currency hedge, one of the most stable international funds you can buy. Then we have VYMI, Vanguard International High Dividend Yield, low cost, hold thousands of stocks. Stocks mitigates your single country risk, low expense, lets you compound. And yes, it is not a cover call ETF. As you've noticed, this list doesn't always have the cover call ETFs just because I am trying to have a balanced portfolio again for the newbies, right? It does have good yield, but not everybody here wants cover call ETFs. If you're into the income side, these picks are for the income side, right? Strict purely income. That doesn't have to be cover call ETFs. So again, I just want to say that before you go off and say, I thought these were all cover call ETFs. I've noticed that not everybody here just buys cover call ETFs like I do. Then we have SCHY from Schwab International Dividend Equity. This is basically the international version of SCHD. So if you have SCHD and you want the international version of it, this is it, right? Strictest quality screens and category. This is a fortress for your capital abroad. Then, of course, we have FID from First Trust International Aristocrats. These are the survivors, right? These are aristocrats that have survived for 50, 60, 70 plus years, hold companies with 10 plus years of dividend increases, proven resilience for your portfolio. And then we have Wisdom Tree, International Hedge, IHDG. This is a currency hedge quality, right? Neutralize that rising dollar risk, massive outperformance versus IEFA. Then we have X Trackers, HDEF, focuses on high yielders but applies value and quality screens to make sure that yield isn't a sign of distress. Remember, don't chase the yield. We always have to figure out where that yield is coming from, right? We want to buy real yield, not fake yield. Then we have iShares International Dividend Growth, IGRO, focus on growers rising cash flows means better NAV protection than those high debt yielders. Then we have Dimensional International Value, DFIV, systematic active. Their profitability factors ensures the value stock you buy are actually making money. Then we have Advantage International Large Cap, AVIV, active profitability, harvests international value premium without the low quality drawdowns. So if you're looking for international, but you only want to cover call ETF, IDVO makes the list. Otherwise, these are more your traditional ETFs that are a little bit higher on the yield. But if you're looking for the double digits, obviously it's going to have to be a cover call ETFs. Uh, in this case, IDVO is a great cover call ETF. I personally would probably own it myself, as I am building out my portfolio. I don't have an international at the moment, just because my strategy right now is I when I buy an ETF or I buy a stock, I do my best to just build up that position until I reach my goal for it. Typically, $100 to $150,000 portfolio, 100 to $150,000 position. I'm kind of OCD like that. I like those type of numbers. So as once I reach my goal, then I move on to the next. All right, value investing, right? Don't buy dying businesses, right? So if you're a VTV uh, investor, right, we have to look at this cynical versus secular. Value investing is tricky. You might be buying a cynical opportunity versus a secular decline, which is a dying business. The active advantage is that you want managers that can tell the difference, right? Indexes cannot. Some of these are CGDV. I used to own this when I was a peer growth investor. Why do you want it? Growth at a reasonable price. FELV from Fidelity, Value plus Momentum, AVLV from Advantage, High Profitability Screening, DSTL, right? Low debt, good cash flow yield. Of course, we gotta do the deep dive, right? So, a lot of this, I think all of this won't be cover calls. This is going to be strictly a more traditional ETF for a large value, right? We have CGDV from Capital Group Dividend Value. I think right now they are one of the best of the list. So if you're going to choose one, I would choose it here, right? From Capital Growth Div Value Act, they use active management. They can hold tech giants that pays dividends, avoiding old economy traps. And one of those ETFs that does this, SCHD. So if you have SCHD, CGDV would be a good complement. So it balances both sides of the market. We have Advantage from AVLV, right? Profitability focus, overweight, highly profitable companies. That this outperforms VTV by avoiding junk value. All right, we have this distillate fundamentals, DSTL. I've mentioned this one before, right? Fundamental stability, low debt screens. This low debt screens makes this behave like a low volatility fund, preserves your NAV. Right, we have SPHD from Invesco, defensive screening, selects 50 least um, volatile high yielders, force you to into defensive sectors like utilities during stress. Then we have VFLO from Victory Shares, growth plus free cash flow. Forward looking screens prevent you from buying cheap stocks that are actually shrinking. Then we have Fidelity Enhanced Value, FELV, Systematic Active, uses momentum and quality to avoid catching falling knives. They rebalance actively for you. So it kind of, it's not really a cover call, but they kind of use that cover call method where it's really, really active management and they play around. MFSV from MFS Active Value. This is the Swan, which just means sleep well at night. They focus on the duration of cash flow and aggressively prune positions for you. Of course, then we have JP Morgan. I mentioned this one, like Java. You have to have high conviction in this. They have discretion to underweight sectors with headwinds, commercial, real estate, right? So this one is would be a high conviction in terms of large value. Then we have FDL, First Trust Div Leader, capacity to buy. Portfolio populates by cash-rich firms. That cash cushion supports the stock price during downturns. And then we have Alpha Architect Quant Value, QVAL, forensic accounting. They aggressively filter out fraud and earnings manipulation. Concentrated deep value. So again, these are the large value. These are the your kind of your if you are a true and to the bone value investor but want some income, this would be it. All right, the new cash, right? If you used to be a B and D, it's time to ditch it. Why take duration risk, right? Traditional AGG, which is aggregate bond, is broken. If rates rises, your price crashes. Why take that risk? This is your upgrade, right? Swap duration risk for credit risk, which is managed actively, or floating rates. I'm not going to say this because I'll just go on to the next slide. I'll just be repeating myself. So I just had it here. I didn't really know why. I could have just had this information and maybe a picture. But let's get into it. Again, some of these, if not, I believe all of them are going to be your kind of your traditional ETF, right? We have Janus Henderson, AAA. These are more like the bonds here. I don't want to get too deep into this because this might not fit um, the channel. I just have this here because some people do like the fixed income. So I kind of had to make this. If you're new, I'm not a big fan of fixed income at all. In a way, I try not to be biased, but I do kind of trash it. However, because you're new, I want to educate you on the fixed income. I don't want to get too deep into this. If you want to pause the video, um, this slide is for you. I don't want to be too into the fixed income, but I wanted to let you know it's out there. So pause the video. You can do some research on this. But if it were come down to me, this is strictly informational and educational slide. I am not trying to get you into fixed income. We are not about fixed income at all on this channel. All right, so that was the last slide. This is my final verdict for you. All right, your all-weather cheat sheet. This isn't a binary choice. It is a spectrum. Here is how you should build this. You should blend all of these counterparts to build a portfolio yielding 69%. Maybe you can even push it higher, but if you're new, the lower the better, right? 69% while protecting your capital. My portfolio right now is about 10 to 11%. I'm gonna try to cap it off at around 15%. Remember, this channel and my philosophy is that we buy and hold for the ultra long term. We are trying to buy and hold for 30, 40, 50, 60 years. I am in my early 30s, currently yielding about $72,000 a year with a minimum goal of $120,000 a year. I want to be able to sustain for that long term. All right, so if you're completely new to income investing, for pure income of upside, use core replacement funds like DIVO, CGDV, AVUV, right? These rely on quality, on business quality. For volatility harvesting, use modern options funds like SPY, JEPQ, iSpy. These are your tax efficient spread, salve NAV erosion. For the safe bucket, use your AAAs, right? These are your JAA, CLOA. These are the cash-like stability with corporate bonds yield. Now, if you're trying to push, if you're a little bit more, if you are new, but you have some experience, all right, I would go with more SPY, QQI. I would push the yield a little bit higher. I would get more the JEPQ, JEPB, right? I would push the yield higher. Just understand that you might see more volatile swings, but if you are a little bit more experienced investor but you're still new to income game, you can still pump out your yield, right? You can try to chase the yield a little bit. As long as you understand where that yield is coming from, that is the most important part. So but for the very, very new income investors, this is where you want to start looking up and start seeing on how to build your portfolio, right? So I don't want you to have that crazy swings in the market because if you're new, you might tend to end up selling and move on to something else. I made a previous video on that, the video before this, right? We call it bunny hopping. You don't want to bunny hop in between stocks and ETFs. That's exactly how you lose money. If you like the video, please like, subscribe, leave a comment. I'm the cover call guy. Thanks for watching. Drop a comment with your favorite income ETF below and we'll discuss it. If you're new again to the channel, leave a comment on something you want to see, what you want to discuss, and I'll try my best to make a video on that. Thanks for watching. Catch you guys in the next. Stay tuned.